I'm going to walk through a debrief using the Capstone Courier. Now, I've made visible several videos from fall 2020 on Moodle, and the content in that is still relevant for this class. So please take a look at that. There's a video that shows how to access the different reports in Capstone, as well as an example of advanced forecasting using the December customer survey scores. The example is based on a Capstone Courier from fall 2020, but the technique is still the same, and the spreadsheet example that I have is still applicable. So you can use those when you start to make your forecasting decisions for your second practice round. Now, I want to remind you of a couple documents that are posted on Moodle, and you should be using them regularly when you are engaged with the simulation. The first one are the solutions to the situation analysis. Make sure to use this. I know I mentioned it in class yesterday, but these numbers you see here are your ideal positions for each segment for each round. And they basically fall on the time frame of your Capstone Career reports. So for example, round one, traditional, has a performance coordinate of 5.7 and a size coordinate of 14.3. So that is going to align with your Capstone Courier for December 31st, 2022, which is the end of your round one decisions. So I'm just scrolling down here to show you this. If we look at the traditional segment analysis, we see performance 5.7, size 14.3, and then if we go back here, it's the same. So that means the end of round two on December 31st, 2023, these next numbers here, 6.4 and 13.6, will be the coordinates that are the ideal spot for traditional. So you want to keep that in mind because this is a moving target. And at times with some of the segments, it can be hard to keep up pace with that. And you also want to pay attention to I'll comment on this with one of the products that's fallen outside of the fine cut. But you want to pay attention to what your strategy is and how you're trying to position it. Now, the other thing too, this is not something you necessarily need to refer to every round, but make sure to take a look at the 6 basic strategies. I know a couple of the teams did this. This document's also on Moodle, and it actually describes the tactics that you'll take throughout the simulation and the types of segments you'll compete in and what your plans are for products that are existing when the simulation starts. Some of them you may use a life cycle strategy and you may let them drift into other segments. For example, you could have a high-end product that you let drift into traditional and then low-end, and then it becomes obsolete over time. So make sure to take a look at this. This will help you. It will give you a structured strategy that you can try to implement. And again, strategies evolve, they emerge, so you may end up having to tweak some things as you compete against your rivals in the industry because they're going to be making decisions as well that are going to impact supply and demand for products within each of the segments. Okay, so now let's dive into the Capstone Courier. So what you want to do, the first thing you want to look at is this first page. This gives you the selected financial statistics. So one thing to say, some things haven't creeped up yet in this particular industry that I normally see that are red flags. They'll happen at some point, and I'll point them out when they occur. For example, there were no emergency loans this round. There weren't any instances of very heavy surplus inventory, which can create problems. So no one had to worry about that this round, so that's good. It may happen next round. If it does, I'll point that out. But this page here shows you some key information just to see how the class is performing as a whole. So remember, the industry growth was about 15% year over year. The annual growth rate is about 15%. So you started with 100 million in sales in round zero. So in theory, you should have about 115 million in sales for round one. Now, if we look at this, we only see three companies that really fell into this growth rate. So Chester did a nice job. They were above that 15% growth rate at 121 million, and Andrews was even better at 130 million. And Baldwin was close. They were at 110 million. So what we see here with these other companies, 103 million, 103 million, 102 million, they did not perform to the standard of the existing growth rate. So that's something that they need to address. Maybe they didn't produce enough products. Maybe their products weren't good enough. It could be a number of factors. So the other thing that I want to just comment on this page that I have highlighted here is the contribution margin. So these are good for Andrews, Baldwin, Chester, and Erie. You want those to be above 30%. Okay? Now, Digby and Ferris both have some work to do. I'm going to highlight Digby here. I didn't highlight them. They were only at 19.6%, and Ferris is at 15.8%. So those can definitely be improved. So you're going to need to look at each of your products. Some of them you're actually losing money on those products. And that means that your price is lower than the cost of making the product. So that's on a per unit basis. That's not good business. So make sure to work on fixing that for the next round. Now I'm going to scroll down and just mention something real quick here. This is the stock market summary. And your stock price should move with your financial performance. If your company is performing well, your stock should go up. If your company is performing poorly, your stock will go down. And we can see that happened here. Andrews did the best this last round, and their stock price went up by $14.66. And Ferris did the worst, and their stock price dropped by $22.90. So that's something to pay attention to. You'll want that to grow over time. You can also consider paying a dividend if you can afford to, because that will be attractive to shareholders and steadily increase that over time. The other thing I want to show you here, I'm not going to go into much detail on this, but I want to just alert you to it quickly. When you get into the simulation, take a look in one of the frequently asked questions sections in the help menu and do a search on the bonds. You need to understand the maturity date and how that's going to impact your finances. This series number here, the 11.0, that's the interest rate, and 2023 is when it matures. The face value is $6,950,000. That amount is going to be due when this matures, and so you're going to need to pay attention to that. It's going to shift over to current debt, and then you're going to have enough cash to be able to pay that off. You can always refinance a bond if you don't have enough cash by issuing another bond that basically captures the value of that bond, and then it pushes out the due date on that new bond. Also, you'll want to take a look at the S&P credit rating score. So you want these to be above a B. This is good, BB, B, B, but these C scores are not good. And that has to do with a number of factors. Could have to do with things such as the leverage, how much debt you have relative to equity, and some other things. But just pay attention to that. Now we're going to scroll down here, and I didn't see a lot of things that were really red flags again. As I mentioned, they didn't come up. Sometimes you'll see this inventory number turn negative, and what that means is that you actually have a surplus of inventory. So this is your cash flow statement, and this is showing a change. And that negative number is showing that you have a buildup of excess inventory. This round, there weren't any companies that have that problem, so no need to worry there. But what I do see here on the cash flow statement is that Digby and Ferris both are negative on that side, so that's showing that they have a loss in income for this round. If we go down and we look at the income statement, we can see that shows down here at their net profit, 9.4 million negative and minus 6.64 million for Digby. That's not good. Again, I mentioned the contribution margins were not good. You're losing money on some products, and that's part of the problem there. The other thing too here is you look at the plant improvements. So this negative number is showing that you actually spent money on plant improvements. If you had sold capacity, you would have actually brought in cash from that, and that would shift to a positive balance for the plant improvement net. What I'll just say here is ideally, especially as a growing company, it's okay to take on debt by issuing bonds to finance your growth. Companies do that all the time. It's normal for a big, large corporation. What you should do, ideally, is match any of your plant improvements, especially early on when you don't have a healthy cash balance. And what I noticed here, Chester didn't really have any major issues, but you had 16 million approximately in plant improvements, and you did not issue any bonds to match that capital outlay that you're making. And so, smart approach would have been to try to finance that, because you just don't know. You could end up, especially early on in the simulation when you're not as familiar with it, you might end up with, you could have had up here excess inventory of 10 or 15 million dollars if you'd produced too much, and you had a bad product, right? Or maybe you needed an emergency loan in that case because of that shortcoming. And so that's why it's a good idea to do your best to match this plant improvement number. You can look at that in your statement of cash flows pro forma and make a decision off of that when you're finalizing your finance decisions. Okay, so that's about all I have to say on this page, and now I'm going to go down, to the next page, which is your production analysis screen or page, and this has a lot of useful information. Excuse me. I've highlighted a number of things here. Some of the key things that I just want to reiterate is you want that 30% or above contribution margin. Some companies, if we look at products like Dune and Fume, your price is actually lower than your per unit material and labor costs. That's not good. That's a money-losing endeavor. Pay attention to that. That's looking at unit economics, the price and the cost per unit. That should be something that you can address immediately. So for the most part, these companies here, Baldwin, they have nice margins there. Some of those are in the 40%. That's good. Another thing too to look at here are the units sold. So again, you use the basic forecasting method for the first round. A lot of companies had stockouts. You didn't produce enough product to meet the demand. That's okay. Next round, you'll probably have some products where you actually overproduce it when you use the more advanced forecasting technique. But what I wanted to show here is an example. I've highlighted a couple here. So you can get an idea of how much unit inventory you have on an annual basis by comparing the units sold to the actual unit inventory that's still on hand, right? So this is 12 months worth of inventory, and just divide the 320, the 185 by the 328 in this case. And as you can see as my note here, that's about 6 months of inventory. If you divide 185 by 328, it's a little over 50%. So that's 6 months of inventory. Try to keep that around 1 to 2 months because you do have inventory carrying costs that you have to deal with. If you had it at zero, or actually I shouldn't say zero, but if you had it at 1 unit, that would be considered just-in-time inventory management. And so in this case, most of the companies actually stocked out with their products, so you missed out on sales. So that's something next round you can work better on the forecasting. For automation, remember you want to automate. So if we go back to the situation analysis, this actually tells you right down here the ideal automation levels. And actually, these are the maximum automation levels. So particularly for your traditional and low-end segments, you want to get these up to 8 and 10 because these are your cash cows, and that's going to reduce your labor cost. For high-end performance and size, these are in your high-tech segments. If you automate too much, then it's hard to push your products quickly through R&D. So take a note of these and definitely add some automation as part of your plant improvements as you go forward. You don't have to do it all at once. You can incrementally build up your automation, but definitely do pay attention to that. Another thing I want to see you do is try to get your plant utilization up higher. So as I mentioned, that there's some inefficiencies because you have this one large company that breaks up into 6 different companies in all these segments. And as a result, there's inefficiencies. Some segments you've got products with too much capacity, some you don't have enough capacity. The growth rates are different too. The low tech segments, it's a slower growth rate, and the high tech segments, it's higher, about 20% growth per year. So these are some things you're going to have to pay attention to. And you could also have new entrants into those segments as companies launch new products or companies reposition their products and let products drift from one segment into another segment. Now, that being said, try to maximize your fixed asset. You've already spent the money, it's a sunk cost. You've already got the asset with the existing capacity. So you want to try to get your plant utilization up over 100%, ideally up around 180%. Once you start getting above 180%, then you can start thinking about buying more capacity for that product, okay? So this is an example here with Able, 66% plant utilization. That is not high use of capacity. So they've got 1.8 million units of capacity for next round. They're only using 66%. So that's just something to pay attention to. If you think you've got too much capacity, you can sell some of it and redeploy it in a more strategic way for another investment that you need. So just something to think about. Okay, now I'm going to go down and we're going to look at some of the segment analyses. And I'm not going to go through all of them, but I just want to point out a couple of key examples that you can go back to. Now, I'm going to start here with the traditional segment. The first thing I want to show you is always pay attention to the customer buying criteria. You should be going back and forth between the Capstone Courier and each of your decisions when you're entering them into the Capstone simulation. Right? So in this case, age is the number one criteria, 47% importance, and price is $19.50 to $29.50. This price range, customers want it to drop. So every year, this range is going to drop by 50 cents. You need to be on top of that because otherwise your product, if you don't change the price, it's going to fall outside that range and you're going to lose some demand for your product. Okay? In this case, that's the second criteria, and then ideal position is the third criteria, and MTBF is the fourth criteria. Okay, now we look here, and I've highlighted fume, which it looks like Ferris tried to reposition or is trying to reposition into this segment. This is what's right on the edge of what's called the rough cut. So products start to lose demand when they fall outside this inner circle, which is the fine cut. The ideal spot is usually somewhere within here. I think, for this one, it's 5.7 and 14.3. So like somewhere around here, I'm guessing is where the ideal spot is. But fume is almost outside this rough cut, and once it's outside that rough cut, customers lose interest. They're not going to buy it. You're going to lose all demand. So this needs to be revised so that it doesn't lose all demand, or you need to find a way to get it into another segment. So those are a couple things that I highlighted there, and then I made some notes here specific to Ferris and its products, why I thought these didn't perform well, and it has a little bit to do with what I was talking about there with the positioning. They're not well positioned. Now, another thing that's interesting on this page here is the actual versus potential. So this shows that, for example, Andrews and Chester could have sold a lot more product, but they didn't produce enough units. And as a result of that shortage, Baldwin, Digby, Erie, and Ferris, they picked up additional sales. So in theory, Andrews and Chester, you could use at the end of the document, there's an actual versus potential sales. You could use that information to help inform your forecasting, basing it off of the potential units you could have sold instead of the actual that you sold when you do your forecasting calculation. So that's something to consider. Okay, now I'm going to go down. I didn't make comments on this. I'm only focusing on the ones that had particular issues that really stood out to me. The main thing I saw were a lot of stockouts. So you could have had better forecasting to sell more. But other than that, I wanted to focus on a couple of the products that actually had a high excess inventory at the end of the round. They produced too many units. And so I looked at Bold and Aft, and I made comments here for both of these. So in the case of Bold, my main comment is that it seems like a decent product. In my opinion, since reliability is the number one criteria, it's at the lower end, 23,000, and it's also at the higher end of the price range. So that could be one of the factors that is decreasing the demand for the product, perhaps. Otherwise, the product is at the ideal spot for this round, 10.4 and 15.3, which is the number two criteria. And then the age profile is not perfect, but it's better than some of these other products. It's around 2. And I would say with Bold, you want to do another revision next round. That'll cut the age in half, so it should be closer to that 1.0 ideal age, although that's the fourth level of importance. For all these companies, you can continue to invest in your promo and sales budgets because customer accessibility and customer awareness scores for a lot of the products in the industry are on the low side, and that's going to help with the demand and the December customer survey score. Again, the closer you get to the performance customer buying criteria, the better your customer survey score for December is going to be, and that's going to also lead to higher market share as well. So assuming you're producing enough units. So those are some things to factor in that you want to pay attention to for sure. It is cumulative in effect. You'll retain some of your customer awareness each round, but some will also drop off. So take a look at the frequently asked questions on that when you're making those decisions to increase your promo budgets. You do start to get diminishing returns with your expenditures there as well. Now, if we look at Aft, the main thing I wanted to comment here, you're in this case, you're not meeting the criteria for age or for ideal position. The other thing too is your price is actually above the price range, so it's going to be less appealing compared to other products, and you're going to lose some demand there. So make sure that you adjust that so that you stay within the range. Again, it's going to drop by 50 cents each year. If we go down, we see this is that page I was mentioning about potential versus actual. You can incorporate this into your sales forecast if you had products that you didn't meet the potential demand. And then I wanted to just mention a comment here. This is a useful perceptual map to look at because you can see when products are drifting into other segments, and it can help you anticipate what the competition is going to be like in future rounds within each segment. So depending on the company's strategy, it could be moving high-end to traditional to low-end if it's doing life cycle. And so you can see as these products drift, and that'll give you a sense of how the supply and demand will be in each of the segments in future years. And then this table is also useful too because it shows you when each product had its last revision. Some of the revisions haven't happened yet, but you can see that all here in one page easily. And then don't forget, in round 2, you're going to have your HR decisions kick in. Again, these aren't going to make or break your performance, but they can impact some aspects of your costs. You can gain some efficiencies with your labor. So take a look at this handout, which is on the Moodle folder that has a variety of Capstone resources. So this defines each of these, and just take a look at it before you dive into making those HR decisions. I think that'll help explain some of the things there. And last but not least, when you do your forecasting for next round, there's actually 2 files on Moodle that you can use, but this one here gives an example with a sample Capstone courier, and then I've also posted a video with another example from last semester. So I hope all these things help you as you move forward in the next practice round, and then you have success in the simulation. I want to see you all do well. I want to see you learn as you go along. I know that there's a lot to digest and learn through this, but the more time you put in now, the larger effort you put in now, reading the frequently asked questions in the help menu, watching video tutorials, taking advantage of the practice rounds, all that stuff, it's going to help you, and it'll get easier as you go throughout the course. Thank you, and I'll see you soon.